Your credit score isn't the only thing watching you in 2026. There's something called an insurance score, and it could be costing you over $1,000 every single year. Most people have never even heard of it, yet it's silently draining their bank accounts. Stick around, because I'm about to pull back the curtain on this hidden system, show you exactly how it works, and give you 5 ways to fix it before your next bill arrives. So, what exactly is this mysterious insurance score? Think of it as a secret report card that insurance companies keep on you. It's a 3-digit number, just like your credit score, but it's not predicting if you'll pay back a loan. Instead, it predicts something much more specific: the likelihood that you'll file an insurance claim. A lower score suggests you're a higher risk, and a higher score means you're a lower risk. It's a simple concept, but the way they calculate it is where things get interesting and, frankly, a little invasive. Now, you might be thinking, how do they even come up with this number? Well, insurance companies aren't just looking at your driving record. They're digging deep into your financial life. They partner with credit bureaus like Experian, TransUnion, and Equifax to pull data from your credit report. But here's the twist: they're not looking at your income. They're analyzing your payment history. Do you pay bills on time? They're looking at your outstanding debt, how much you owe across credit cards, loans, and mortgages. They're checking the length of your credit history, the types of credit you use, and even how recently you've applied for new credit. All these financial habits are fed into a secret algorithm that spits out your insurance score. It feels like you're being graded on your entire financial life, not just how you drive or maintain your home. It's crazy to think about, right? This score has a huge impact on your wallet, yet a recent study showed that over 90% of Americans have no idea it even exists. Why the secrecy? Well, for one, it's complicated. It's not as straightforward as a speeding ticket raising your rates. Insurance companies aren't exactly advertising that they're judging you based on your credit card payments. And because it operates in the background, most of us just assume our premium is based on our driving record or the age of our roof. We get the bill, we sigh, and we pay it, never knowing there's a hidden number working against us. This lack of awareness benefits the insurance industry, allowing them to quietly charge higher premiums to those they deem riskier based on financial data. Now, before you get too worried, you should know that some states have pushed back. California, for example, has banned the use of credit-based insurance scores for setting car insurance rates. Massachusetts and Hawaii have similar restrictions. In Maryland, companies can't use your score to deny or cancel your policy, but they can still use it to set your initial premium. And in Washington, there's been an ongoing battle, with regulations changing back and forth. But for the vast majority of the country, this practice is completely legal and widely used for both auto and home insurance. If you don't live in one of those few protected states, it's a safe bet that your insurance score is impacting what you pay. So, let's connect the dots. How does this score secretly inflate your premiums? It's all about risk pools. Insurance companies group customers together based on their perceived risk level. If your insurance score is low, you get placed in a higher risk pool, even if you've never had an accident or filed a claim. People in this pool are charged more to offset the potential for future claims from the entire group. It's a system of collective punishment where your financial habits, not your actual history with the insurer, can brand you as a liability. This means you could be paying hundreds, or even thousands, more per year than someone with an identical driving record and home, all because their financial report card looks better than yours. Let's look at a real-world example to see the staggering difference this can make. Imagine 2 drivers. We'll call them Alex and Ben. Both are 35 years old, live in the same neighborhood, and drive the exact same 2024 Toyota Camry. They both have a perfectly clean driving record now. Accidents, no tickets. On the surface, their premiums should be identical. But Alex has an excellent insurance score of 900 because he has a long credit history and low credit card balances. Ben, on the other hand, has a poor insurance score of 550. Maybe he missed a few payments during a TOUGH time or recently opened several new accounts. Alex gets a quote for car insurance at $1,200 per year. Ben, with the exact same profile, gets quoted $2,500 per year. That's a difference of $1,300 for the exact same coverage, based on nothing but a hidden score. Now multiply that over a decade. That's $13,000 extra, gone. Okay, that was the bad news. The good news is that you have the power to change this. Your insurance score isn't set in stone. Here are 5 practical ways you can improve your score, and you can start today. First, and most importantly, pay every single bill on time. Late payments are the #1 killer of both your credit and insurance scores. Set up automatic payments for everything: credit cards, utilities, your mortgage. Consistency is key. Second, keep your credit card balances low. This is about your credit utilization ratio, the amount you owe compared to your total credit limit. A high ratio signals financial stress to insurers. Aim to keep your balances below 30% of your limit, but under 10% is even better. If you have high balances, focus on paying them down as quickly as possible. Third, don't close old credit cards. A huge part of your score is the length of your credit history. Even if you don't use an old card anymore, keeping the account open shows you have a long, stable history with credit. Closing it can actually shorten your credit history and lower your score. Just store it away safely. Fourth, limit your applications for new credit. Every time you apply for a new loan or credit card, it generates a hard inquiry on your report, which can temporarily dip your score. It suggests you might be taking on more debt. If you need a new loan, try to do all your rate shopping within a 2-week period so the inquiries are bundled together as a single event. And finally, number 5. Check your credit report for errors. You are legally entitled to a free credit report every year from all 3 major bureaus: Experian, Equifax, and TransUnion. Go to annualcreditreport.com, the official government-mandated site. Comb through your reports carefully. A simple mistake, like an account that isn't yours or a payment incorrectly marked as late, could be dragging down your insurance score without you even knowing. If you find an error, dispute it immediately. So, with your next policy renewal on the horizon, what should you do? Don't just let it off. The price you're repaying today was based on your insurance score from 6 months or a year ago. If you've spent the last few months implementing these 5 steps, your score has likely improved. This is your moment to cash in. About 30 to 45 days before your renewal date, it's time to go shopping. But this time, you're shopping with the knowledge of how the game is really played. You can contact your current insurer and ask them to reevaluate your rate based on your improved credit information. Some will, some won't. But more importantly, you should be getting quotes from multiple other insurance companies. Each company weighs the factors in your insurance score differently. The insurer that gave you a high rate last year might offer you a much better one now, while a different competitor might give you an even better deal. The only way to know is to compare. Before you renew your policy, make sure you're not overpaying because of a hidden score. Check this first. Your mission is to get your credit report, clean it up, and then shop around with at least 3 to 5 different insurance companies to ensure your premium truly reflects your risk, not just a secret number you never knew existed. Taking these steps could easily save you hundreds, if not thousands, of dollars. Thanks for watching, and don't forget to subscribe for more tips on how to keep more of your hard-earned money.